Malay Vanakam, everybody in Coimbatore. Thank you so much for having us here. This is the MCX Investor Protection Fund Commodities Knowledge Series and MCX IPF Commodity Stakeholder Initiative that we are taking forward this evening. Today we're going to talk about an asset class that's very unique, and it's extremely perfect if you want to diversify your existing portfolio or if you want to multiply your wealth by sort of de-risking yourself, adding a pinch of diversity to your existing portfolio, or if you're starting out as an investor in the commodities market. The right mix of commodities in your portfolio can really shore up your gains and reduce the risk component at the same time. The pricing in commodities has actually been much less volatile than in equities or even bonds for that matter. So that's how amazing the commodities market can prove to be for all the investors as well as traders. Commodity market participants are sitting definitely on what I would like to call a gold mine of opportunities. But the only way you can mine the gold out of it, or the only way you can milk it, is by using the right tools, the right strategies, and most importantly, by making yourself aware, by equipping yourself with the knowledge of the tools that you can exercise and the ways you can multiply your wealth at this juncture. To kick off officially this evening's event, I'd like to call on stage Dr. Venkatachalam Shanmugan. He'll take this conversation forward. He'll give us an overview of the Indian commodity derivative markets and the economic utility that it has to offer.
So, very good evening to everyone, and thank you for sharing your valuable time to be with us to understand what the commodity markets are and how would you invest in commodity markets. This is a form of an economic democracy wherein you leverage information and trade in the commodity markets actually, or invest in the commodity markets. Commodities goes in cycles, so they don't give you an attractive investment opportunity as equities. But why commodities? Commodities because are a perfect hedge against inflation. So we need to be protected against these prices. So this market gives you a platform to protect against the inflation that you face. So to that extent, what is the amount that you should put to protect you against the inflation that you need to take a call on? Number one. And you have investments in companies which have exposures to commodities actually. So in that case, you should also look into whether these companies are hedging their commodity exposures. So to the extent that you have a commodity related equity investments, you should have exposures in those commodities where the companies are involved in either as a raw material or producer of the finished products. And third, it gives you a good, commodity portfolio diversification measure. So accordingly, you can do your own research, find out which commodity that you should get involved into your portfolio, and so thereby, you'll be better off actually. So if you become a master, you're able to read the momentum, then you can trade and gain from the commodity markets actually. By looking at the exchange traded prices, it gives you some leverage on what is the price that you should be getting, if at all, if you're buying that particular commodity. And the final aspect, when we came into the regulation of Securities and Exchange Board of India, which is also regulator of all the listed companies actually, so they made one requirement mandatory in the corporate governance disclosures of the companies. So what is that requirement? That all companies which are having commodity risks and are undertaking commodity risk management should inform this in their annual reports actually. So as an investor in these companies or equities actually, you should look into whether they are exposed to commodity risks and whether they are disclosing these commodity risks in their annual reports, and whether they are also discussing whether they are protecting their commodity risks on the market platform using market-based instruments or maybe physical market-based strategies actually. So having said that, so this is essential that commodities, commodity derivative markets, the instruments that are being traded, and the utility of these markets, the basic being the price discovery and the price risk management. You should make best use of it so that you become a better planned, financially planned individual for your better future. Thank you, Karanya, for this opportunity.
After an overview of the Indian commodity derivatives market and its economic utility, what followed was a riveting panel discussion between subject matter experts around price risk management using commodity derivatives.
Commodity prices, how much of a role do they have when it comes to the $5 trillion economy goal that we have by 2025? What is the general perception at this point in time about commodities? Is it really picking up among the masses, among investor community, trader community, or is it still that perception of being a speculator's club is still there?
I mean, being from the exchange which promotes trading in commodities, I would tend to deny that perspective, that, it's not as speculators then. Actually, there are also hedgers in the markets. They are coming and hedging their exposures in the market, so you can really see in their annual reports. Coming back to the question that you asked, how much significant the commodities are in the $5 trillion dollar economy that we are aiming at. Actually, we need to take a greater initiative in terms of developing the commodity derivative markets. The more the industries protect their commodity risks, the more they remain efficient and competitive, and so they will be able to compete with the global countries in their exports, and so we become a big manufacturing nation. So as we become a big manufacturing nation, then there is a huge service ecosystem that builds around it, and that takes us to the $5 trillion economy. And so, having said that, it is necessary that we have a stronger market so that the manufacturing economy remains protected from the risks and remain efficient and competitive, so that we will produce for exporting these in a competitive world.
Santosh, just to rope you into the conversation, those of us who are still yet to start investing in commodities and are still sort of testing waters, there's a spot market and there's derivatives market. Could you tell us the pros and cons, or rather the advantage that derivatives offer at this juncture, and what would be the benefits of going for it?
Actually, spot market is the market where you are going for a contract like purchasing at a spot. And derivative market is like you are going for a contract which is a buyer is going for a contract for getting that product in a particular period. It depends on the market conditions. So the benefit is we can beat the inflation. So for that we need to invest in the future market.
So Gyanashekhar, is there enough awareness amongst investors about risk management at the moment?
About investors, not much, but corporates definitely have that kind of knowledge.
Even smaller businesses?
Smaller businesses are kind of getting used to it only now. They've not been exposed to the way of managing price risk. They're kind of understanding that it's very important function of their way of doing business to manage price risk efficiently. The top corporates have definitely started in a big way, but medium-sized corporates have just started getting into it, getting a taste of it. But I think there are clear signs among medium-sized corporates and other industries who are using most of these commodities. They're definitely testing waters, they're getting into it, but I think it's still got some time to go. And MCX is doing a great job. I think the awareness which they've given about the markets and how to manage price risk is definitely getting there.
That's the aim. We all hope to go back home with some money-making strategies and tools equipped fully to trade in the commodities market. Mr. Shankar, he was just talking about how corporates have been able to really benefit with adopting risk management when it comes to commodity. Coming from your own experience, why don't you share with our viewers, our audiences here, how effectively hedging for gold and other precious metals has helped your business thrive, and the entire industry also, if you could do some trend spotting for us.
Basically, what has happened is the jewelry industry is going through a change. Till now, hitherto, it was a traditional family-run business, and slowly it is becoming corporatized. And looking at the price fluctuations and things like that, any prudent jeweler would want to hedge themselves against the price risk. So how do you hedge yourself and insulate yourself from the price risk? The best way is to hedge yourself with the exchange, or hedge yourself by taking a gold loan from a bank. And there are two things to it here. One is, if you're going to hedge yourself in the commodity exchanges, yes, there's going to be a cost involved in it. And if my calculation is right, it is approximately around 15 to 20 rupees per gram. And if somebody doesn't want the margin calls and other things and cash flows to be affected, probably they can even get into futures and options. And in futures and options, the cost of hedging is relatively less, where you only pay the premium rather than the margins. So as a jeweler, we 100% we hedge ourselves from the price risks and the fluctuating market.
Mr. Gyanashekhar, could you shed some light, because you've been tracking the space for a very long time now. How important is it to hedge yourself, and how much can it impact a company's profitability?
See, what typically happens is most of them have businesses where a certain output is committed. For that, raw material price risk is extremely critical, because if you keep buying raw material to produce the product, and the raw material prices fluctuate so much, you can't go back to the retail and keep changing prices like how the prices fluctuate in the physical market. So internally one needs to manage that price risk. The only problem, what I have seen so far with most of the corporates is there's a thin line between trading and hedging. For them, hedging is still a speculative activity. That mindset needs to be changed. Many of them, though they have physical positions, for example, if you're buying cotton to make an end product, if they know cotton prices are going to rise, instead of buying more physicals, you go and buy more of derivative positions also. So you're taking a risk both on the physical market as well as in the derivative market. So that has to change. People have to understand that hedging is essentially to protect the bottom line, and not to sort of generate more profits or into more speculative activity.
Just to add one more point. See, basically the jewelers need to make money on the making charges and the wastages, not on the rising gold prices. See, today the price might rise and you'll never know what's going to happen tomorrow. If there's going to be a change in US government, the metal is going to fall, or there's going to be any change in the tariff value, the metal is going to rise and things like that. The ideal situation would be 100% of the stocks has to be hedged. Okay? If at all, at least 50% the jewelers should insulate themselves from the price risk.
Which are the commodities most suitable for derivative trading?
Actually, as per rules, any commodity which we can keep for 15 days can be taken as an derivative contract in MCX. If you're taken as in Coimbatore, it will be a jewelry. Okay. So here most of the industries like pump manufacturer industries are there. So copper will be one of the best, and many aluminum related companies are there. So they can use the opportunity to hedge their raw material against the price risk in aluminum. So even cotton, many of them are not using the opportunity. If they use this opportunity and they hedge in MCX or future contracts, they might reduce their risk. So cotton, gold, and lead, copper. These
Dr.
are
Shanmugam
all,
is nodding very intently. In fact, he was telling me that Coimbatore cotton and metals is very high. So let's talk about trading for these two commodities specifically. Would you like to tell our audiences certain things to keep in mind, especially or rather specific to cotton and base metals?
So I would say that why not a petrol futures? Why not a diesel futures actually? So today, petrol and diesel prices have been, connected to a formula, wherein it has to change every day. For fleet operators, it's a huge cost, paying for the petrol and the diesel that they pay. So petrol and diesel futures are something which, when introduced or allowed to be introduced, could be something great. And, ATF futures, so you pay, you pay for the airfare to fly anywhere actually, and of which you know that 40% of the cost is ATF cost actually. And the higher the fluctuation of the ATF, and since we don't have ATF futures actually, the current crude futures does not fit out to be a good or an efficient hedging instrument. And in addition to it, ATF futures don't change every day; they change every 15 days actually. So once the government moves ATF to everyday pricing and then allows us to launch ATF futures, that would be a huge blessings, wherein thereby a hedged airline will give you a better ticket cost actually. So coming back to the question that you were asking about cotton futures and then the base metal futures. So cotton futures, it's again delivery based. Deliveries happen in 5 or 6 delivery centers actually. So those textile industries, which are into spinning and who procured the ginned cotton for spinning into the threads, or who are into yarn manufacturing and spinning, and everyone would have an indirect exposure to the cotton. It is better that they get protected against the cotton exposure that they have. So in total, if you look at the cost of hedging, it's about 6 to 7% actually. And today, more importantly, since you raised this metals thing, all the metals in MCX are deliverable actually. So you don't need to worry about something. If I get the delivery as an industry, what would I do? Transport it from Mumbai and use it over in Coimbatore if the economics work. And if economics doesn't work, just square off your positions and get out of the market and financially safeguard your physical market positions. So that's what I would suggest. So of the 5 metals, almost 4 of the metals are delivered in Mumbai, and only 1 gets delivered, which is lead, gets delivered in Chennai. Beyond that, all those which are important regulatory compliances, please ask your broker as to what should I meet with in terms of number of open positions that I can take, and when it comes to near month, what is the number of cotton contracts that I have to close and then come into the near month futures contract. And so when I say near month contract, sitting in December, the December delivery contract is the near month contract. So you have to cut down your position. So those are regulatory requirements. You need to keep in touch with your broker and be apprised about. If you don't, then you end up in paying penalty, which will be a huge cost for you.
Just to add to what Mr. Shanmugam was saying, recently we have, as a jeweler, we have started taking physical deliveries from MCX, and we were finding it quite comfortable. Number one, it becomes a natural hedge, and number two, on the price discovery part. And I also take this opportunity to reduce the margin for jewelers who are doing perfect hedging. So probably I think it's around 5 to 7%. So probably if you can bring that down, probably you'll have more players, more physical buyers will come into the market.
This is actually a risk capital that we accumulate at the markets actually. So once gold becomes less and less volatile, you can see the margins naturally coming down. So the margin goes up with the volatility and goes down because we protect your risks. That's the principle behind margins.
No, I'll just add to that, Dr. Shanmugam. Actually, as a hedger, this is a rule that's there in overseas exchanges, that if you prove to the exchange that you have inventories against which you're hedging, then the margins will be reduced automatically. As a hedger, you have special margins. So I don't know if it will be applied here in these exchanges.
If you have a physical gold which you are hedging on the exchange, not that which you are taking delivery on the exchange actually, you can put that as a collateral against the margin, and against the value of the gold, you can take about, if you have put in about a crore rupee worth of gold in the exchanges vault actually, you can take exposure to the extent of about 60 lakh rupees for your margin payment actually. So that's a huge benefit that you get by putting in an inventory into the exchange vault and then take in a position on the value of the gold that you have stored in the vault.
You mean to say that I will have to give physical gold to you as a margin and trade against
as a
that.
collateral.
As a collateral.
As a collateral, and you take a value on that collateral, and of that value, which is 60 to 65% approximately, which is also announced by the exchange from time to time, you will be given exposures to the margin that you have to pay.
With that, we're going to wrap this up. Thank you so much to all our panelists, Mr. Gyanashekhar, Mr. Shankar, Santosh, as well as most importantly, Mr. Dr. Shanmugam. Thank you so much for all the four of you for this enlightening conversation. And thank you so much to all the audiences. I'd like to request you all to give a round of applause to yourselves. I hope you're all going back much more enlightened, much more enriched and equipped as far as commodity trading is concerned.